Welcome back to our channel. We are super excited to have you back. Cryptocurrency has changed the game in finance, but let's face it, crypto taxes can be confusing. In today's video, we're going to simplify the complex world of U.S. crypto taxes for 2024. Whether you're a seasoned investor or just getting started, we'll show you how to stay compliant with the IRS and make tax season stress-free. Plus, we'll dive into how tools like CoinLedger can save you time and effort. We have included a link to get your own account with CoinLedger, which will help you get organized today. Look for the link in the description and on the first pinned comment below the video. The information provided in this video is for educational purposes only and should not be considered as financial, tax, or legal advice. Cryptocurrency tax laws are subject to change, and individual circumstances may vary. Please consult a qualified tax professional or financial advisor to address your specific tax situation. While every effort has been made to ensure accuracy, we do not guarantee the completeness or reliability of the information presented. Use any tools or resources mentioned at your discretion. Now let's jump right in. In recent years, the rise of cryptocurrencies has transformed the financial landscape, making it essential for investors in the United States to understand the intricacies of crypto taxes. As digital assets gain popularity, so does the need for clarity on how these transactions are taxed. This understanding is crucial, as failing to comply with tax regulations can lead to significant penalties and legal issues. In this video, we will delve into the importance of grasping crypto tax obligations, ensuring that you, as an investor, are well-informed and prepared to navigate this complex terrain. We will cover several key areas, starting with the fundamental requirement of reporting your cryptocurrency transactions to the IRS. This includes understanding what constitutes a taxable event, such as selling, trading, or using crypto for purchases. We will also discuss the various tax implications associated with these activities, including capital gains, taxes, and how they differ based on the holding period of your assets. Additionally, we will highlight the recent changes in IRS guidance regarding crypto transactions, which have introduced new rules and clarifications that every investor should be aware of. These updates can significantly impact how you report your earnings and losses, making it imperative to stay informed. By the end of this video, you can expect to have a clearer picture of your responsibilities as a crypto investor in the U.S., equipping you with the knowledge to make informed decisions and avoid potential pitfalls. Whether you are a seasoned trader or just starting your journey into the world of cryptocurrencies, understanding these tax implications is vital for your financial health. We aim to provide you with practical insights and actionable steps to ensure compliance with IRS regulations while maximizing your investment potential. So, stay tuned as we break down these essential topics and empower you to take control of your crypto tax obligations. In the United States, the taxation of cryptocurrencies primarily revolves around two key concepts: capital gains tax and income tax. Capital gains tax applies to the profit made from selling or exchanging cryptocurrencies, while income tax is relevant when you receive crypto as payment for goods or services. When you sell or trade your crypto assets, the IRS treats these transactions similarly to stocks or other investments, meaning that any profit you realize is subject to capital gains tax. This tax is calculated based on the difference between your purchase price, known as the cost basis, and the selling price. It's essential to differentiate between short-term and long-term capital gains tax rates, as they significantly impact your overall tax liability. Short-term capital gains apply to assets held for 1 year or less and are taxed at your ordinary income tax rate, which can be as high as 37% depending on your income bracket. In contrast, long-term capital gains tax rates apply to assets held for more than 1 year and are generally lower, ranging from 0% to 20% depending on your taxable income. This distinction emphasizes the importance of holding periods in determining your tax obligations. The implications of holding periods on tax liabilities are crucial for investors to understand. By holding your cryptocurrency for over a year, you can potentially reduce your tax burden significantly. For instance, if you bought Bitcoin at $10,000 and sold it for $30,000 after holding it for more than a year, you would pay long-term capital gains tax on the $20,000 profit, which is typically lower than the short-term rate you would incur if you sold it within a year. Additionally, if you receive cryptocurrency as income, such as through mining or as payment for services, this income is taxed at your ordinary income tax rate, which can further complicate your overall tax situation. Understanding these nuances is vital for effective tax planning and compliance, ensuring that you maximize your returns while adhering to IRS regulations. By grasping how crypto is taxed in the U.S., you can make informed decisions that align with your financial goals. Reporting crypto transactions on your annual tax returns is a critical process that requires careful attention to detail and accurate record-keeping. The importance of maintaining precise records cannot be overstated, as it ensures that you can accurately report your gains and losses to the IRS. Given the volatile nature of cryptocurrencies, where prices can fluctuate dramatically, having a comprehensive record of each transaction, including dates, amounts, and the purpose of the transaction, will help you substantiate your claims and avoid potential audits or penalties. When it comes to filing your taxes, several platforms can simplify the process for you. Popular options include TurboTax, TaxAct, and H&R Block, which offer user-friendly interfaces and specific features designed for cryptocurrency reporting. These platforms often provide guidance on how to input your crypto transactions, calculate your capital gains or losses, and ensure compliance with IRS regulations. Some even integrate with cryptocurrency exchanges, allowing for seamless importation of your transaction history, which can save you time and reduce the likelihood of errors. It's also essential to be aware of the deadlines for filing annual tax returns in the U.S. Typically, the deadline for individual taxpayers is April 15th of each year. However, if this date falls on a weekend or holiday, the deadline may be extended to the next business day. For those who need additional time, the IRS allows for an extension request, which can provide an extra 6 months to file your return, pushing the deadline to October 15th. Keep in mind that while an extension gives you more time to file, it does not extend the time to pay any taxes owed, so it's crucial to estimate your tax liability and make any necessary payments by the original deadline to avoid penalties and interest. In summary, accurately reporting your crypto transactions on your annual tax returns is vital for compliance and financial health. By maintaining thorough records, utilizing reliable tax filing platforms, and adhering to deadlines, you can navigate the complexities of crypto taxation with confidence. This proactive approach will not only help you avoid issues with the IRS, but also empower you to make informed financial decisions regarding your cryptocurrency investments. Calculating your crypto taxes can be a daunting task, but tools like CoinLedger, formerly known as CoinLee, can simplify the process significantly. To get started, the first step is to set up an account on the CoinLedger platform. This typically involves providing your email address and creating a secure password. Once your account is established, you can select your preferred cost basis method. The cost basis method determines how your gains and losses are calculated and can include options like FIFO, first in, first out, LIFO, last in, first out, or specific identification. Choosing the right method is crucial, as it can impact your overall tax liability. Next, you'll need to import your transaction history from various exchanges and wallets. CoinLedger makes this process straightforward by allowing you to connect directly to your exchange accounts or upload CSV files containing your transaction data. This feature ensures that all your trades, purchases, and sales are accurately captured, which is essential for calculating your gains and losses. If you have multiple wallets or exchanges, you can repeat this process for each one, ensuring that your entire crypto portfolio is accounted for. Once your transaction history is imported, CoinLedger will automatically calculate your capital gains and losses based on the cost basis method you selected. This automation not only saves time, but also reduces the risk of human error, which can be particularly beneficial given the complexity of crypto transactions. An important aspect of using CoinLedger is the ability to generate detailed tax reports that comply with IRS requirements. These reports provide a comprehensive overview of your crypto activities, including realized gains and losses, which you will need when filing your tax return. Having a well-organized tax report is vital for IRS compliance, as it substantiates your claims and helps you avoid potential audits or penalties. In summary, using tools like CoinLedger can streamline the process of calculating your crypto taxes. By setting up your account, selecting the appropriate cost basis method, importing your transaction history, and generating detailed tax reports, you can ensure that you are well prepared for tax season. This proactive approach not only simplifies your tax obligations, but also provides peace of mind as you navigate the complexities of cryptocurrency taxation. Understanding the tax implications of various crypto activities, such as mining, staking, and airdrops, is essential for any investor looking to navigate the complexities of cryptocurrency taxation. When it comes to mining, the rewards you receive for validating transactions are considered taxable income. The IRS treats these mining rewards as ordinary income, meaning you must report the fair market value of the coins at the time you receive them. This value is added to your taxable income for the year, and you will be taxed at your ordinary income tax rate, which can vary based on your overall income level. Similarly, staking rewards, which are earned by participating in a proof-of-stake network, are also taxed as income. When you receive staking rewards, they are treated in the same manner as mining rewards. You must report the fair market value of the tokens at the time they are credited to your account as part of your taxable income. This means that both mining and staking can significantly impact your tax liability, making it crucial to keep accurate records of the rewards you earn. Airdrops present another unique tax situation. When you receive tokens through an airdrop, the IRS requires you to report these as income as well. The taxable amount is based on the fair market value of the tokens at the time they are received. This means that even if you did not actively participate in a transaction to receive these tokens, you are still liable for taxes on their value. It's important to note that failing to report airdrop income can lead to penalties, so maintaining accurate records is essential. Furthermore, when you eventually dispose of any mining, staking, or airdrop rewards, whether through selling, trading, or using them, you may incur capital gains tax. This tax is calculated based on the difference between your cost basis, the value at which you receive the tokens, and the selling price. If you hold these rewards for more than a year before selling, you may qualify for lower long-term capital gains tax rates. Understanding these tax implications is vital for effective tax planning and compliance, ensuring that you are prepared for any potential liabilities arising from your crypto activities. By staying informed, you can make strategic decisions that align with your financial goals while adhering to IRS regulations. Handling losses from crypto investments and theft is an important aspect of tax planning that can significantly impact your overall tax liability. According to IRS guidelines, investors have the ability to offset losses against gains, which can help reduce taxable income. This means that if you have realized gains from selling some of your cryptocurrency, you can use any realized losses from other investments to offset those gains. For instance, if you made a profit of $5,000 from selling Bitcoin, but incurred a loss of $2,000 from trading another altcoin, you can subtract the loss from your gains, resulting in a taxable gain of $3,000. This strategy is known as tax loss harvesting and can be an effective way to minimize your tax burden. When it comes to losses due to theft or scams, the IRS has specific guidelines that investors should be aware of. Historically, losses from theft were treated as casualty losses, but the Tax Cuts and Jobs Act of 2017 limited the ability to claim these losses. Currently, losses from theft or scams involving cryptocurrency can only be claimed if they are considered a theft loss under the IRS rules. This means that you must be able to demonstrate that the loss was due to a criminal act, such as hacking or fraud. However, it's important to note that personal theft losses are not deductible unless they occur in a federally declared disaster area. To clarify further, let's consider some examples. If you were scammed into sending cryptocurrency to a fraudulent exchange and lost your investment, you may be able to claim that loss if you can prove it was a theft. Conversely, if you simply made a poor investment decision and lost money on a trade, that loss would not be deductible. Similarly, if your wallet was hacked and your funds were stolen, you could potentially claim that loss provided you have sufficient documentation to support your claim. In summary, understanding how to handle losses from crypto investments and theft is crucial for effective tax management. By offsetting losses against gains, you can reduce your tax liabilities, while being aware of the IRS's stance on theft-related losses can help you navigate potential claims. Keeping detailed records and documentation of your transactions and losses will be essential in substantiating your claims and ensuring compliance with IRS regulations. The taxation of non-fungible tokens, NFTs, has become an increasingly important topic as their popularity continues to rise among creators and investors alike. NFTs are generally treated as collectibles by the IRS, which means they are subject to specific tax implications that differ from traditional cryptocurrencies. When you sell an NFT, any profit you make is subject to capital gains tax, and because NFTs are classified as collectibles, they are taxed at a higher rate. Specifically, long-term capital gains from collectibles can be taxed at a maximum rate of 28% compared to the standard long-term capital gains rates of 0%, 15%, or 20% for other assets. This distinction can significantly impact the net profit you realize from selling NFTs, making it essential for investors to understand these tax implications. For creators of NFTs, the tax treatment is equally important. When you create and sell an NFT, the income generated from the sale is considered ordinary income and must be reported as such on your tax return. This means that if you sell an NFT for $5,000, that amount is added to your taxable income for the year, and you will be taxed at your ordinary income tax rate. Additionally, if you incur any costs associated with creating the NFT, such as gas fees or platform fees, these expenses may be deductible, potentially reducing your overall tax liability. The implications for both creators and investors extend beyond just the sale of NFTs. If you decide to trade or exchange NFTs, those transactions can also trigger tax events, requiring you to report any gains or losses. For instance, if you trade one NFT for another, the IRS considers this a taxable event, and you must calculate the fair market value of the NFT you received to determine your gain or loss. Given the complexities surrounding NFT taxation, it is crucial for both creators and investors to consult a tax professional who is knowledgeable about cryptocurrency and NFT-related transactions. A tax expert can provide tailored advice, help you navigate the intricacies of reporting, and ensure compliance with IRS regulations. This proactive approach can help you avoid potential pitfalls and maximize your tax efficiency, allowing you to focus on your creative endeavors or investment strategies without the added stress of tax complications. Understanding the tax implications of NFTs is essential for anyone involved in this burgeoning market, ensuring that you are well prepared for tax season and any potential liabilities. We've explored several crucial aspects of cryptocurrency taxation that every investor and creator should be aware of. We began by discussing the importance of understanding crypto taxes in the U.S., emphasizing the need for accurate record-keeping and compliance with IRS regulations. We then delved into how cryptocurrencies are taxed, focusing on capital gains and income tax, and highlighted the differences between short-term and long-term capital gains tax rates. We also examined the process of reporting crypto transactions on annual tax returns, stressing the significance of generating detailed tax reports to ensure IRS compliance. Additionally, we covered the tax implications of various crypto activities, including mining, staking, and airdrops, clarifying how these activities are treated as income and the potential capital gains tax when disposing of rewards. Furthermore, we discussed how to handle losses from crypto investments and theft, including the ability to offset losses against gains and the IRS's stance on claiming losses due to theft or scams. In our exploration of non-fungible tokens, NFTs, we highlighted their tax treatment as collectibles, which come with higher tax rates, and discussed the tax implications for creators and investors alike. Throughout the video, we underscored the importance of consulting a tax professional for personalized advice tailored to your specific tax situation, especially given the complexities surrounding cryptocurrency and NFT transactions. We encourage you to take these insights to heart and consider how they apply to your own crypto activities. Tax regulations can be intricate, and seeking professional guidance can help you navigate your unique circumstances effectively. If you found this video informative, please take a moment to subscribe to our channel for more valuable content on cryptocurrency and tax-related topics. We have included a link to get your own account with CoinLedger that will help you get organized today. Look for the link in the description and on the first pinned comment below the video. Don't forget to like this video and share it with friends or fellow investors who might benefit from this information. Your engagement helps us create more content that empowers you to make informed decisions in the ever-evolving world of crypto. Thank you for watching, and we look forward to seeing you in our next video.